The best of the emerging market voices you will hear only here today. Let's welcome in our next guest, Manpreet Gill. He's been tracking, really for a long time what's happening with various emerging markets, various development markets. Manpreet Gill of Standard Chartered is now with us. Manpreet, your perspective on how is India placed versus the other emerging markets? How will India grow versus the other emerging markets? Can you tell our viewers?
Good morning. I think from India actually stands out reasonably well. I think one differentiation we always take as a starting point is that we think Asia is fundamentally in a very different place to the rest of the emerging market universe. Let's not forget that when we think about many of the stress points in emerging markets, whether it's on the currency side, with external balances or foreign exchange reserves, a lot of those stressed economies actually sit outside of Asia. So I think that's one fundamental starting point that it always helps to keep on top of mind. Within the region, look, I mean, there are obviously, Asia has a very wide mix of economies, but I think India's strengths here are reasonably well buffered external balance. But I think in a volatile world, the strength of the domestic economy and the domestic orientation, that's definitely an advantage. And as regional investors, when you look across the landscape across in Asia, I think the diversified equity market portfolio and the strength of domestic demand and the domestic focus, that's always one of the key criteria when thinking about investing in Indian assets or elsewhere in the region.
One of the key things, key arguments to invest into any place would be the earnings growth, the GDP growth that we're talking about. Well, in India, the GDP growths have come, but it has been lagging the earnings growth. Do you think it will pick up because of the base effect now?
Yes, I think that will play a part of a role. But I think, again, when you're thinking as a regional investor, the absolute number is less important than the relative one. Because at the end of the day, the question for us is, are you getting a similar level of returns elsewhere, or can you do better? I think when you look as a regional investor, look, there are markets we do sort of like across the region. We like a lot of North Asian markets, China in particular still, because earnings growth is still actually quite strong in those markets. But to be honest, Indian earnings growth is still not so bad. I mean, you start comparing it with more defensive markets like Malaysia, for example, the earnings growth is actually not too bad. You also want to think about how much currency risk and what kind of sector mix you take on. And that's where I think Indian equities still offer you, when you think on a relative basis, we think is still a solid core holding in this region. And if we do get the equity rally that we expect late cycle in this region and globally, we still think Indian equity should be a key beneficiary in that.
Hi, this is Nayantara joining in from New Delhi. Good to have you on the show. I want to just talk a little more about that theme. You're saying that, we perhaps are better off than the rest of the emerging markets. Perhaps there is some rally that is left when it comes to the equity markets. What's your view as far as the debt outflows goes? And what about the fact that you're seeing a good recovery in the United States, the rate arbitrage, which is also at play, maybe, which is why you're also seeing the outflows, and the commodity markets, you are seeing a lot of outflows. So I'm not able to understand on what basis you really think that we could still see a rally.
Sure. Now, I think the one binding factor across all those factors you mentioned is the US dollar. There's a strong historical relationship that when you get periods of US dollar strength, that's when you see a lot of outflows across emerging markets, both from equities as well as debt. And I think it's exactly what we've seen over the first half of the year. Similarly for commodity prices, because a lot of them are denominated in US dollars. But I think there are two sort of overriding factors we keep in mind here. Number one is we do think that the dollar has room to weaken. We did expect a short-term rally, but it's got quite stretched. And when we think of the key driver of that rally, we think interest rate expectations in the US have actually run quite far, while they haven't budged at all in other major economies like the euro. So looking out the next 6 to 12 months, we do expect the dollar to turn lower. And again, if that relationship holds, that should mean we should see a turnaround in some of those flows. The last factor we're keeping in mind is that, look, we think we're late stage in the cycle, and that's a point when equity markets in the US and across Asia have historically done well. So unless this cycle is going to be quite different from previous ones, we'd question what would cause, the equity market returns and bond market returns indeed to be very different from the last one. That's why we're positive.
Manpreet, give us a sense also with what you're seeing in the commodity markets. Are you seeing a reallocation of funds being shifted from equities to maybe the commodity markets? And the second one I want to ask you is when people now look at India, maybe a month back, 2 months back, 3 months back, it was almost understood that Narendra Modi would come back with a thumping majority in 2019, and that's not a risk at all to the equity markets. Are they as confident of that today? Are you seeing any fears around that, and therefore is it impacting allocations as well?
Sure. I think maybe on your first point, I think I wouldn't really comment on fund flow specifically. I think on the commodity space itself, we have a reasonably sort of range-bound view, regardless of where you look. I mean, at the end of the day, most metal prices are still driven by Chinese demand, and we have seen quite a bit of slowdown there. Gold's never been a favorite purely from an investment point of view because, well, it simply doesn't yield you anything, so it needs to keep going up just to keep up with something as simple as a fixed deposit. But it may still hold some value, we think, as a little bit of a risk hedge. Oil, of course, quite critical for a lot of equity markets, especially here in India. We actually think outside of short-lived excursions, to $80, yes, are absolutely possible. But we think the demand-supply balance is actually turning a little bit to not be as extreme as it was about a year back. So we think it's, oil prices, Brent at least, more like to stay below $75, in the 65 to 75 range, which at least should not be a net new negative. Political risk, look, it's always there, and we're not in the business of forecasting politics. But I think the key lens which we view political events through around the region and here in India is one of uncertainty. I think at the end of the day, look, if you end up with outcomes that raise uncertainty, markets will all be concerned about what to expect next. But at the end of the day, unless we end up in that kind of outcome which creates a lot of uncertainty, markets will, we think, get on with the business of focusing on fundamentals. And that's why we're so focused on how markets perform late cycle and what the basics of earnings and valuations are. We think outside of any kind of shocks, and we're still some distance away from the election, those are what we should be focused on as investors. Indeed, that's what we're focusing on.
Manpreet, I know you answered about flows and what do you expect. I just wanted to understand that what happens, with all the noise going around the Fed fund rates, the dollar index, will emerging market currencies have a reverse? All that will play a very important role in asset prices across emerging markets?
It will, and I think that's where we come back to the point where we think the US dollar is still the binding factor here, because we can focus as much as we want in terms of what domestic fundamentals are, what the earnings outlook is, but in most Asian markets, most emerging markets where foreign investor flows are still quite a key determinant of demand and price moves both on the fixed income and equity side, the dollar is still going to be a big driver of what those flows do. So that's the reason why we're quite focused on the dollar. We do think that dollar will weaken and which will turn supportive once again for emerging markets. But if you look across our global allocations, we are thinking about making sure we have diversification across both the dollar positive sort of markets, emerging markets, but also markets like US equities, which are less dependent on what the US dollar does. So I think keeping that mix is important. If we're right, and we do believe that dollar will be weaker, emerging markets should also do well, and Asian equities we think are a much better place to be than equity markets outside the region. But regardless of what the US dollar does, the US is one area where you do get the earnings and a valuation backdrop, both of which are, we think, more attractive than in most other regions. And that's a market which is less sensitive to the dollar as well. So we think that's actually a good mix to have at what we think is a late stage in the cycle.
Manpreet, today we did see the markets not being enthused by the slew of economic data that came out of China. Now, if you're seeing status quo growth in China in the midst of a trade war, what could it mean for an economy like India? Does it stand to gain? Can it take away some of that business?
Potentially, yes. I think what's interesting about a trade war is that, we tend to think of it, of course, very negatively, that, will it shrink the global pie? And look, as economists, we can debate that at a global level. But I think two sort of factors stand out. I think one is, look, if demand is reallocated away from China because tariffs make them more expensive, ultimately there should be beneficiaries elsewhere. And no reason India shouldn't be a beneficiary from that. It definitely wouldn't make things worse. But second is that I think where India is sort of a little bit different from the rest of East Asia is that it is ultimately a more domestic oriented economy compared to most other Asian economies. So these are periods where that can end up being a source of stability. So we think on both fronts, look, we need to be cognizant of global mood, and if we see sort of risk appetite suffer, we'll undoubtedly see short-term impacts on financial markets. But I think at a fundamental level, if India can be a net potential beneficiary, or at least not a net loser, and get that stability from being a more domestically oriented economy, we actually think it might be a good place to be if you do see trade tensions begin to escalate even further than where we are today. So it's definitely a theme we have in mind, and that's where I guess it comes back to a core point about not only being bullish on equities, but ensuring investment allocations are sufficiently diversified. Trade is, one of the top risks we're watching. There are a lot of risks out there, and we think making sure that diversification to markets like India is ultimately a core part of our investment approach.